Most beginners look at a stock chart and literally just see dollar signs. They're completely hyper-focused on how much money they can make. But professional traders, it's completely flipped. They obsess over exactly how much they can lose. Welcome to this explainer. Today we're diving deep into the 1% risk rule. This is arguably the absolute most important concept you're ever going to learn, and honestly, it's your ultimate shield for actually surviving the markets.
So what actually separates the top 4% of successful day traders from the 96% who, well, fail? If we look at the retail trading data, a staggering 72% of day traders experience net losses. It's a brutal reality, right? But here's the thing. The difference between the winners and the losers? It isn't some highly guarded secret indicator. It's not a magic moving average. The difference is 100% rooted in how they manage their downside.
Think about the stark contrast in these two mindsets. When a beginner enters a trade, their very first thought is almost always, oh man, if this goes up 10 points, I'm going to make $1,000. They're completely dialed in on the reward. Professionals, though, they build their entire strategy around survival first. Before they even think about clicking that buy button, they're asking, okay, where am I wrong and exactly how much is being wrong going to cost me? They know that protecting their capital is literally the only way to stay in the game long enough for those profits to actually compound.
And that brings us to establishing a hard, unbreakable boundary, the 1% rule. Now, this means risking a maximum of 1% of your trading account equity on a single trade if your stop loss is hit. But wait, I want to be crystal clear here because this is where so many people get tripped up. This does not mean you only put 1% of your total account balance into the trade position itself. Not at all. It means that if your trade idea is completely invalidated, if you are totally wrong and your stop loss is triggered, the absolute maximum dollar amount you lose is capped at 1% of your entire account.
Let's actually run the math on this, because the numbers really don't lie. Look at what happens if you hit a terrible, and I mean horrible streak of 10 consecutive losing trades. At 1% risk per trade, you're down about 9.6%. Yeah, it stings, but you're alive. You're still in the game. But look at what happens if you just double that risk to 2%. Suddenly, you're down 18.3%. Push it to 3% risk? You've lost over 26% of your entire account. And here's the kicker. To recover from a 26% hole, you don't just need a 26% gain. You need a 35.7% gain just to get back to zero, just to break even. Risking 2 or 3% per trade literally creates a mathematical death spiral.
Now, the most fascinating number in all of this math is that 9.6%. Think about it. After 10 straight losing trades at 1% risk, you still have over 90% of your capital completely intact. And look, even a great trader with a solid 50% win rate has roughly a 1 in 1,000 chance of losing 10 trades in a row. Over the course of a couple thousand trades, it's almost guaranteed to happen to you at least once. So the 1% rule isn't about trading scared. It simply ensures that when that inevitable, brutal losing streak finally arrives, your account actually survives it.
Okay, so how do we actively put this into practice? Let's walk through the exact step-by-step math. Step 1, take your current account equity. And I mean today's balance, not what you deposited 6 months ago. Step 2, multiply that by 1%. That gives you your maximum dollar risk. Step 3, find your stop-loss distance. This is the exact dollar amount per share or per contract where your trade is undeniably wrong. Step 4, divide your maximum dollar risk by that stop-loss distance. Boom, that gives you your position size. Oh, and a pro tip, always round down to a clean number. Never ever round up.
Let's ground this with a really concrete scenario. Say you're trading with a $5,000 account. 1% of that is $50. That $50 is your absolute ceiling. If your stop loss gets hit, you lose no more than $50. Period. But what if the market is super volatile today and your setup requires a much wider stop loss than normal? It's simple. You just reduce your position size to keep the total risk under that $50 mark. And what if the trade absolutely requires risking more than your $50 limit? You skip the trade entirely. It really is that straightforward. Your discipline absolutely has to override your fear of missing out.
Because here's the undeniable truth of the markets. Without fixed risk, your results become completely random and highly emotional. When you trade without strict limits, you are basically inviting psychological chaos right into your life. Think about it. If you risk $50 today, $500 tomorrow, and then maybe $200 the next day, your results mean absolutely nothing. You won't even know if your strategy actually has an edge or if you just got lucky on the big days and blew up on the wrong ones. Making your losses completely predictable is literally the only way to evaluate your actual trading skill.
And that brings us right to the psychological traps, the common account destroyers. Because even if you know the 1% rule, these bad habits will absolutely bleed you dry. The deadliest one? Moving your stop loss mid-trade, just to give it a little more room. If you plan to risk $500 and you drop your stop lower as the price falls against you, guess what? You literally just doubled your risk instantly without adjusting your size. Other massive destroyers include using mental stops instead of hard orders in the system, which fail the second you hesitate, confusing the total cash you put into the trade with your actual risk, and of course, bumping up your size to revenge trade right after a painful loss.
To really drive this concept home, stop-loss orders and position sizing are your absolute last lines of defense. A hard stop-loss is just a mechanical way to automatically close a position at a predefined level. It completely removes the emotion from the exit. You set that stop order before your entry order even fills, not after you see how the trade is playing out, and definitely not when things start looking scary. A hard stop protects you from sudden market gaps, crazy news events, and honestly, most importantly, it protects you from yourself. But let's be totally honest for a second. Having your rules jotted down on a notepad on your desk, that's one thing. Actually executing them flawlessly under intense emotional pressure, that's a whole different ballgame. So how do you actually enforce this discipline automatically? Enter TradeZella. Because just having the rules isn't enough anymore. You really need a professional infrastructure to actively enforce, track, and analyze whether you're actually complying with those rules. TradeZella is just an absolute analytics powerhouse built specifically for this. First off, it auto-syncs with over 500 brokers, so your data is completely flawless, no manual entry. It tracks your R multiple, which basically normalizes your trades to show you exactly where you exceeded your planned risk. Like if you plan to risk 1% but you actually lost 2%, TradeZella flags it immediately. It even features Zella AI, which acts kind of like a digital trading partner, catching behavioral deviations, like when you start oversizing. But the absolute game changer here is Trade Replay. You can literally replay your past losing trades tick by tick, candle by candle, to see the exact moment you let emotion override your plan. It takes risk management from a guessing game and turns it into a measurable science.
All right, so the final verdict is crystal clear. Trading without limits is exactly how accounts get destroyed. The 1% rule is not about being overly conservative or, trading with fear. It is the fundamental mathematical foundation for surviving long enough to actually get good at this. Sure, anyone can have a lucky week, but your strategy can only survive those inevitable losing streaks if your risk is strictly, ruthlessly controlled.
It is time to stop leaving your trading account to chance. Automate your discipline, track your mistakes, and keep that 1% rule locked in tight. Click the exclusive link to secure 20% off TradeZella today. Stop guessing and start measuring. Because before you enter your very next position, you have to ask yourself one question. Are you trading to get lucky today? Or are you managing risk so you can stay in the game tomorrow?